Today, our topic is: should you keep investing in the stock market crashes during periods of volatility? It can be tempting to stop investing, however, there are few reasons why it could actually be safer to keep your money in the market. Regardless of what happens with the market, there are ways to protect your investments. Nobody can know for sure whether a downturn is imminent, but you can still prepare for one. The stock market has experienced some intense ups and downs over the last couple of months after dropping 13% from its peak in early January, and S&P 500 has nearly recovered from those losses in the last 2 weeks. Still, though, some investors worry that between the war in Ukraine, high inflation, continued supply chain issue, and other macroeconomic factors, more volatility could be on the horizon. To be clear, nobody can accurately predict exactly how the market will perform. A crash may or may not be looming, but its stock prices do take a steep tumble. Should you keep investing while they were dropping, and what can you can to do protect your money along the way? Keep investing even in the downturns. When the stock market is shaky, it can be tempting to sell stocks to take risk off the table or to stop investing altogether. However, in most cases, it's wise to continue investing as you would at any other time. The market is unpredictable. If you let fear lead you to pull your money out and then share prices surge, you will miss out those gains. And if you reinvest later once price are higher, you are liable to end up paying more to get back into those stocks than you previously sold them for. While it may sound, it's actually safer to keep your money in the market during periods of volatility. While your portfolio may take hit in the short term, the US market as a whole has long track record of recovering from crashes. If you stay invested in a diverse array of stocks, you would be able to simply ride out the storm and wait for the market bounce back. It can also be wise to buy more shares during downturns when stock prices drop broadly. Their creators opportunities to load up on high quality stocks at discount prices. Then once the market rebounds, your portfolio will reap the reward. How to keep your money safe? Continue to invest during market downturns can be smart, but there are a few other strategies to consider that will help you to keep your money as safe as possible. First, only invest money you won't need to use in the near future. While the US market is extremely likely to bounce back from the given crash, it could take months to even year for it to fully recover and start touching new high. If you have a well stocked emergency fund that is not invested in the equities, even if the unexpected occurs, you should be able to leave your stocks alone. That will allow you to avoid situations where you are compelled by circumstances to sell investments then when their values are low. Also, given the level of concern about a possible looming downturn, now would be a good time to review your investments and check that each stock you own still deserves its spot in your portfolio. The companies that are most likely to survive a market crash that are ones with strong underlying business fundamentals. When a company itself healthy, its stocks has a better chance to performing well over the long haul despite periods of volatility. Crashes can be unnerving of even the most experienced investors, but there are steps you can take to protect your money by continuing to invest and choosing the right stocks, your portfolio is more likely to thrive in the long term, regardless of what happens with the market in the short term. Stocks just posted worst quarter since COVID market crash, but Buffett's new favorite sectors logged meteoric accents as toppling. Top line, the stock market closed out its worst quarter since the pandemic, includes market crashes in early 2020 on Thursday, but the energy sectors fueled by spiking oil price has posted a stunning rally, but with experts predicting the surge will only continue aimed heightened inflation and rising interest rates. Key factors. Uh, Though the broadened S&P 500 slumped 4.9% in the first quarter, the S&P 500 energy index has nearly 40%, expli- eclipsing the second best gain of 4% by utility and market, one of the only their sectors in positive territory. The S&P decline since January has sobered up bullish investors, but the energy sector has pulled off a meteoric ascent. But of America's Savita's Subramaniam said in a note of client last week, predicting the sector should continue to outperform even if geopolitical risk subside and heightened inflation continues. Headline: the sector's stunning first quarter runs up the S&P stock uh, petroleum more than 98% for the best quarter over, buoyed by a new nearly 1 billion investment early this month from legendary investors Warren Buffett, Berkshire Hathaway, the oil giant biggest. Last week, BMO Capital analyst Philip upgraded Occidental shares to reflect high oil price while also applauding the firm as ambitious and visionary plan to achieve net zero emissions before 2040, echoing praise from Buffett, who last month said Berkshire, who bought all we would after being impressed by CEO Vicky Hollow on Occidental latest earning call, though energy stock crashes as pandemic lockdowns taken oil demand in the first quarter of 2020. The sector has now more than recouped those losses of the S&P. Then best performing stocks this quarter, seven hails from the energy sectors with Apple and Marathon surging 67%, 55%, and 55% respectively, reaching their highest level in the nearly 4 years. With oil prices still above 100 per barrel, energy stocks could fall victim to knee-jerk sell-off in the event than tensions between Russia and Ukraine. Decastle, but stock price are still near record lows relative to profit, and the sector is also working to attract socially minded investors with plans like Occidentals and incentives, say Subramaniam. Key backgrounds: oil prices have been on a wild ride over the past 2 years, fueling volatility among energy stocks that tend to move in tandem prices speeded into negative territory for the first time in the history during the spring of 2020 when COVID lockdown led to a glut in supply that became too expensive to maintain. Though the S&P returned to a new high within 6 months, oil prices didn't recover. Exxon performing stock plugging 40% fast forward to 2022, and raising energy prices have fueled the highest inflation in 40 years ahead of President Joe Biden ban on Russia oil import this month. Oil price spiked to a nearly 14-year high, exports up 36% this year. Tangent. The reopening economy and massive scale stimulates helped the fuel on the strongest start of bull market over thanks largely to low investor rates. LPL Financial in emailed comments. Now, with the Federal Reserve raising rates and underwinding the economic sports stock and particularly those in technology are struggling. The communication service sectors, which includes the Facebook parents Meta and Google's Alphabet, has plugin 10% this year, while the information technology sectors has slumped 8.5. Our last topic is what to watch for. Though rising oil prices have been a boon to energy firms, some analytics are worried their implications could stunt economic growth. In a note to client this month, Bank of America Ethan Harris said the worries that stronger than anticipated Fed tightening combined with an oil price talks or other unforeseen expect faster rate hikes in light of sustained inflation and lowered its forecast for growth domestic products growth next year to 1.7% from to 1.8 compared to 5.7% last year.